What we are going to learn today is capital expenditure decision. As always, first we will understand what are capital expenditure decisions. Understand, suppose there is a company who wants to purchase a machinery, or a company who wants to purchase another company, or a company who wants to replace its plant. This all decisions for a company, I'm not saying whether they should do it or not, but this all decisions for a company are long-term decisions. They require huge capital expenditure and are not easily reversible. They are irreversible practically. If you purchase a machinery and tomorrow you think that I should not purchase this machinery, you need to sell it and buy another machinery, which is practically impossible. So these are not easily reversible decisions. Whether to purchase a machinery or not, whether to purchase another company or not, whether to replace the plant or not, this all decisions are capital expenditure decisions, and they are also termed as capital budgeting. Whether we should do capital expenditure or not is also termed as capital budgeting. These are long-term, requiring a huge capital outflow, practically irreversible decisions which we are going to take. Normally, these decisions are taken by higher level management. So it is expected from a chartered accountant that you should be very comfortable in taking this type of decisions. How to take a decision? Try to understand. I am going from small, whether we should purchase machinery or not. Or in another way, whether it is financially feasible to purchase a particular machinery or not. We are directly starting methods of taking capital budgeting decisions. First method is net present value. What is NPV? Try to understand. NPV is a present value of cash inflow minus present value of cash outflow. Now you will say me, sir, you directly started this method. We have not understood how to take capital budgeting decisions. Wait a while, you will get each and everything. I am explaining you logic of taking capital budgeting decisions by one of the method, which is net present value. And this method says, if NPV is positive, you should purchase. If NPV is negative, you should not purchase. If NPV is 0, you are indifferent. That is, you may purchase, you may not purchase. This is a method of taking capital expenditure decision. Sir, what is the logic? Try to concentrate. We are planning to purchase a machinery. What will be cash flow from this machinery? This machinery can be utilized only for 3 years. This is the machinery of manufacturing a mobile, and mobile normally gets obsolete in 3 years. And so this machinery is not going to be used more than 3 years. What cash flow this machinery will generate? It is difficult to find, But say we have hired some accountants and economists who have found out what are the cash flows. We are not talking about profits. I am talking about cash flows. What are the cash flows which are related or which are occurring from this machinery? 100 crore in first year, 100 crore in second year, and 100 crore in third year. After that, machinery will be sold at 0 rupees. In fourth year, you will not be having this machinery, and hence in fourth year, there will be no cash flow. How much cash flow this machinery is generating? 100 crore in first year, 100 crore at the end of second year, and 100 crore at the end of third year. Those all are inflows. Forget about the method of NPV. How we value a machinery in finance. We have understood to value anything. What we need to do is present value of future cash flows. What are future cash flows in this machinery? 100 crore in first year, 100 crore in second year, and 100 crore in third year. What is required rate of return? What is the discount rate? What is cost of capital of this company? Company who is planning to purchase this machinery, what is the required rate of return of this particular company? Say required rate of return is 12% for XYZ Limited. What does this mean? XYZ Limited purchases anything, do some business only if they earn minimum 12% rate of return. So what are present value of future cash flows in this case? What will be our valuation of machinery? Remember second lecture of ours. We have done this. How to value a asset in finance, pin in finance, aeroplane in finance. Everything is present value of future cash flows. Let me find out present value. This is 1 divided by 1.12 raised to 1, 1 divided by 1.12 raised to 2, and 1 divided by 1.12 raised to 3. What you can do if you have forgotten lecture number 1, 1 divided by 1.12 is equal to GT multiplied by 100. And as I have told you, I am not having GT, so I need to do this. 1 divided by 1.12 is equal to M plus is equal to M plus is equal to M plus. MRC multiplied by 100. I am assuming you all are very comfortable with finding out present value. 240.18. 240.18. Again, I am revising something about lecture number 2. This is our valuation for machinery. This is maximum price XYZ Limited is ready to pay for this machinery. This is market price of machinery. No, this is not market price of machinery. This price we have found out by considering our required rate of return. This cannot be a market price. This is our valuation. Remember that example of jeans. By touching the jeans, by seeing the company, I thought that the jeans is of 2000 rupees. This is our valuation in finance. This 240.18 crore is nothing but our valuation in finance. Now try to understand situation number 1. If market price of this machinery is 150 crore rupees, what is our valuation? What is the valuation done by XYZ company? It is 240.18 crore. What is the market price of this machinery? 150 crores. We have done this in valuation also. We took some decisions. Can anyone tell me, can repeat the decision, what you should do in situation number 1 in this scenario when market price of machinery is 150 crore? I'll also ask you why. Yes, Kushali. Yes, and we also did it in Hindi. Market में सस्ता मिल रहा है, we should purchase it. And exactly quoted by Kushali, it is undervalued by the market. Anything which is undervalued by the market, we should purchase it. I am writing down the answer. It is undervalued by the market. By seeing the genes, we feel it should be of 240 crore. When we saw the tag, it is only of 150 crore. We should purchase it because it is undervalued by the market. We should purchase it. The decision should be purchase. Let me go to a method which I have told you in capital budgeting. We have not done anything about this method. While explaining this method, I have just written it. I have not explained you the logic. But this is the same logic of finance. NPV is nothing but logic of finance. Let me find out NPV in this case. What will be NPV in this case? NPV is present value of cash inflow minus present value of cash outflow. What will be cash inflow if I purchase this machinery? 100, 100, 100. What is present value of cash inflow? 240.18. Minus present value of cash outflow. If I purchase this machinery, what will be my cash outflow? 150 crore. What will be NPV? Is 90.18 crore. Positive or negative? Positive. And it is said in the answers, or it is explained in NPV, if NPV is positive, we should purchase it. What will be decision as per NPV? It will be purchase. Sir, then why we are learning NPV method if the answer can be solved by the concept of finance? It is a concept of finance converted into formulas and rules, so that every time you don't have to think whether it is undervalued by the market, overvalued by the market. Everything is taken into consideration. If NPV is positive, it will be undervalued by the market. Your decision should be purchase. So this is one and the same. Whether you do it by the concept of finance or whether you follow a method of NPV, it is one and the same. Again, understand in this case, NPV is positive. What does NPV positive means? This machinery is earning what? How much profit? Can anyone tell me why we are purchasing this machinery? This machinery is earning what? Correct. This machinery earning is profitable. No, we have never taken profit. We always take cash flow. This machinery is earning more than 12% rate of return. This machinery is earning more than 12% rate of return. How much more? It is in terms of present value 90.18 crore rupees more than 12%. It is 90.18 crore rupees more in terms of present value. It is earning more than 12% or less than 12%. 110% it is earning more than 12%. Why? Try to understand when we are doing the question. The company accepts any project only if minimum it gets 12% rate of return. Why a company do not accept a project if it gets 4% rate of return? Because then it can not take a risk, put money in fixed deposit and earn easily 6% rate of return rather than 4% rate of return. that everything, all opportunity costs are considered in this 12%. And ultimately, company is accepting the project because the project or the machinery is earning more than 12% rate of return. This is important. See, solving the question by NPV is not only important. This is important. Machinery is earning greater than 12% rate of return. I am going to situation number 2. If market price of machinery is 290 crore, what is our valuation in machinery? It is 240.18 crore. $240.18 CR. Yes, again one student. As per the concept of finance, should we purchase this machinery or not? Same student, Kushali? Because it is overvalued by market. Market में महंगा मिल रहा है. Anything which is overvalued by the market, we should not purchase. From the concept of finance, what answer we have got? We should not purchase. Let us use concept of NPV. NPV is the same concept as valuation of finance. Present value of cash inflow minus present value of cash outflow. Present value of cash inflow is 240.18 minus, if I purchase this machinery, what will be cash outflow? 290 crores. What will be my NPV? Negative. Negative how much? 240.18 240.18 minus 290. It is 49.82. What does the concept says? If NPV is negative, you should not purchase the machinery. See, answer is same. So NPV ultimately is a concept of finance. It is not something out of some author has written out of the blue. It is concept of finance. You don't have to every time think whether you will purchase or not purchase, overvalued, undervalued by the market. Even if it is easy, here it is more easy. If there is a positive sign, you will purchase. If there is a negative sign, you will not purchase. Whenever NPV is negative, NPV is negative. Why we are rejecting the project? Why we are not purchasing the project? Try to understand. Because we are incurring losses. Not a good financial manager. You are still accountant. You are not gone into the concepts of finance. There is no concept of profit and loss in finance. This is an incorrect statement to make. I can prove it. Try to concentrate. What is the cost price of machinery? 290 crore. How much money we are totally earning? 300 crore. So what will be the profit for 3 years? I tell you. We are getting 300 crore. Minus we are paying only 290 crore. There is a profit or loss? There is a profit of 10 crore rupees. For the period of 3 years, you cannot use this word because we are incurring losses. Then why we are not purchasing? Why we are rejecting this machinery? Try to understand. Because XYZ is not earning 12% rate of return. Means this machinery is earning less than 12% rate of return. See, when we started the question, the company is ready to accept the machinery if it gets 12% rate of return. In this, company was getting more than 12% of rate of return, so company accepted the project. In this, company is getting less than 12% rate of return. Company might be earning 5%, 6%, 8%. But company says that we will accept the project only if the minimum required rate of return is 12%. So here the project is not earning 12%. Never speak this. The project are incurring losses. The project is earning negative rate of return. Conceptually, you are incorrect. This project might be earning positive rate of return. If you purchase this type of company having negative NPV, your EPS still might be positive. You might be earning some profits, but they are not more than 12% or equal to 12% rate of return. And so you don't want to do this type of project. So if the company is incurring losses, not a good word. Company is incurring negative rate of return, not a good statement. Company is getting less than 12%, and so company is not purchasing this particular machinery. One of the most important situation, I hope you are getting this right. In one question, we have taken three different situations. If the market price is 150, if the market price is 290, and situation number 3, if market price is rupees 240.18 CR. What is XYZ's valuation? 240.18 CR. Let us understand what the normal financial manager will do. Market has neither overvalued nor undervalued, so market has exactly valued. You should purchase or not purchase, you are indifferent. What is the meaning of indifferent is you may purchase, you may not purchase. Let us go to concept of NPV, present value of cash inflow minus present value of cash outflow. What is present value of cash inflow? Is 240.18 minus present value of cash outflow is 240.18. This is present value of cash inflow, this is present value of cash outflow. What is NPV? 0. And what does the answer of NPV says? If NPV is 0, you are indifferent. I have proved 3 times that NPV is exactly same logic, is having exactly same logic as the concepts of finance, undervaluation, overvaluation. Most important point is, what does it mean when NPV is equal to 0? Any student who want to try? How much rate of return you are earning? I think this machinery is earning 0% because this answer is 0 rate of return. Yes, Shabina.
Machinery is earning 12%.
You are exactly correct. See, indifferent means you may purchase it because this machinery, even if this figure is 0, is earning exactly 12% rate of return. So normal answer will be purchase. Why? Because the company was saying that if we are earning 12%, we will accept the project. So you may even write down the answer as accept the project. But this is one of the most important concepts. Please understand in situation number 2, how much actual rate of return we were earning? We don't know, but we know it was less than 12%. In situation number 1, how much actual rate of return we were earning? We don't know, but we know it was greater than 12%. In situation number 3, how much exact rate of return, actual exact rate of return we are earning? We know this. It is equal to 12%. So when NPV is 0, you are earning your discount rate. This should be a good understanding to learn. When NPV is 0, what does it mean? You are earning your discount rate. What is the discount rate? The rate at which you have discounted your cash flow. Rate at which you have discounted your cash flow, you are exactly earning it. Sir, how much actually we are earning in this, or how much actually we are earning in this? We don't know, but we are going to learn in the concept of IRR. If you find out exactly what rate of return the company is earning, you can easily find out the answer of IRR, which is nothing but actual what project, machinery or company is earning. This is concept of NPV. And I am summarizing method number 1, which is NPV. How to find out NPV? Present value of cash inflow minus present value of cash outflow. It will consider that undervaluation, overvaluation. Most important, if NPV is positive, that means market has undervalued, that also means project is earning greater than required rate of return, and so you should accept the project. Number 2, if NPV is negative, मार्केट एज ओवरवैल्यूड, मार्केट में महंगा मिल रहा है, प्रोजेक्ट इज अर्निंग मे बी मशीनरी मे बी कंपनी लेस देन रिक्वायर्ड रेट ऑफ रिटर्न, इन अवर क्वेश्चन लेस देन 12%, hence you should reject the project. If NPV is equal to 0, market has exactly valued, project is earning exactly required rate of return, and so normally we write down answer as indifferent. You may even write down purchase. It is absolutely correct answer because you are getting your required rate of return. This is understanding as well as decision making of first method of capital budgeting, which is nothing but NPV, net present value, which is nothing but present value of cash inflow, which is nothing but our valuation in finance, minus present value of cash outflow, that is nothing but market price of the asset in finance, and we compare it, it will be automatically compared, and just by positive, negative and zero we may take a capital budgeting decision. This was first method of capital budgeting decisions. We are going into deep of concept of this. When we find out NPV, it is present value of cash inflow. Now understand, I am trying to purchase a company. The company will present its profit. We are taught up till now, we prepare trading profit and loss account, and what company gets is nothing but profit. We have never found out cash flow of the particular company, and we are trying to find out that. We are going to find out cash flow, or if we want to purchase a particular company. Try to concentrate. I'm taking an Excel sheet where the calculation will be somewhat easy for me. So I'm taking this Excel sheet. Suppose my sales is 1 lakh rupees. Sales 1 lakh rupees, my variable cost is 40% of sales. So variable cost is 40,000 rupees. What is my contribution? 60,000. See now what I am taking. I am deducting all fixed costs which are cash, but not a depreciation. So this is fixed operating cost, but we have not considered depreciation, which is to say nothing but 20,000. See, a new name is coming into picture now. EBDIT, earning before depreciation, interest and tax. Why depreciation is still to be deducted, and why we are doing depreciation separately, I'll explain you that. But this is nothing but EBDIT. From EBDIT, the current year's depreciation, suppose this is year 1 only, we are talking only about year 1. Current year depreciation is say 15,000. What will be EBIT? What is EBIT? It is nothing but operating profit. So what we have deducted? Variable cost, fixed cost excluding depreciation, and then we deducted depreciation. So we are getting operating profit, which is EBIT, which is 25,000. Interest, this is financial fixed cost. Interest is nothing but 5,000. Interest is nothing but 5,000. So what is my EBT? 20,000. Tax rate is 40%. So 20,000 into 40% is 8,000. 8,000. So my EAT will be 12,000. Earning after tax is 12,000. My preference dividend is 2,000 rupees. What is my earning after tax? Preference dividend, equity dividend, whatever I have paid in cash, I have deducted from my sales. Tax I have paid in cash, fixed cost I have paid in cash, everything cash I have deducted from sales. And this is a 10,000, which is nothing but my earnings or net profit. Try to understand. I am assuming this sales was cash. All variable cost paid is cash. All fixed operating cost excluding depreciation is cash. This interest is cash, taxes are cash, and preference and equity dividend is cash. But depreciation is always non-cash. What I want, I told you, I want cash answer. I don't want profit answer. But still I am having right now profit answer. It is not cash. Why? I have deducted depreciation, which is nothing but non-cash. So what I am doing, try to understand. If I have deducted a depreciation, now I will add back that depreciation. Because I have deducted it, I will add back that depreciation. What is depreciation? 15,000. I will add back that depreciation. So I will add 15,000. What is my cash? Is nothing but 25,000. So understand. What was my profit? 10,000. I know one of the cash item, non-cash item, which is depreciation, I have already deducted. See, I have deducted. And so I will add it back again to get my cash profit. And why I want cash profit? Because finance says the answer can be found out by present value of future cash flows. Future cash flows. And so I want answer of cash profit. And this is how I find out answer of cash profit. Now try to understand this point. Sir, if you want to deduct the depreciation, if you are adding back that depreciation, then why not ignore depreciation? Something which is deducted, again it is added back, then why not just ignore it? You can ignore depreciation. Why? Because you want to find out cash, and depreciation you know is non-cash. You cannot ignore it. Can any student give me the answer why we cannot ignore it? Yes, Sabina.
So that is allowable for income tax.
Exactly. And so my mathematical answer is, if I don't deduct depreciation over here, then this tax figure will be incorrect. Exactly, it will be somewhat more. Depreciation is allowable under section 32 of Income Tax Act. And so if you don't deduct the depreciation before deducting taxes, this answer will be incorrect. It will not be earning before tax. See, taxation is not based upon cash flow. Our decisions are dependent upon cash flow. So you cannot change taxation rules. There, mercantile system will be applicable, where under section 32 depreciation is allowable. So first you will have to deduct the depreciation to get correct cash answer, correct tax answer. And once you get correct tax answer, you will be getting correct profit after tax. Once you get correct profit after tax, you can add back this 15,000 because they were non-cash. Now everything is going in a good manner. Why? Because our tax answer is correct. Even the thing which was non-cash, we have again added it back. And so we have got a correct answer of cash profit. How we do it? A very simple way, try to concentrate. We take earning before depreciation, interest and tax. Earning before depreciation, interest and tax. I am taking one more example. EBDIT is 1 lakh rupees. From EBDIT, we deduct the depreciation. Depreciation in this case was 40,000 rupees. And so my earning before interest and tax is 60,000. I am assuming over here interest is 0. So I am directly deducting tax from EBIT. I have assumed in both the cases interest is 0. And so taxes are 40%. Taxes will be 24,000. Earning after tax will be 36,000. Our profit answer is correct because we have already deducted depreciation. Now the depreciation was a non-cash item, so we need to add it back because I want cash profit and not net profit. And so I am adding back my depreciation, which was 40,000 rupees. What will be my cash profit? My cash profit will be 76,000. Cash profit will be 76,000. All of you concentrate. By knowing this, you can solve questions of capital budgeting. But you need to learn, understand the concept of other method also. The same 76,000 answer can be found out in this manner. Interest is still 0. We are finding out the same answer. What is EBDIT? 1 lakh. I am directly deducting taxes. Sir, we cannot do it. Why? Because depreciation is allowable under Income Tax Act, allowable expenditure under Income Tax Act. And to find out correct tax, you need to first deduct depreciation. Agreed. But I am still violating that rule and directly deducting taxes. What is the taxes? 40%. What is 40% on 1,40,000? Sir, this 40,000 is not correct. Agreed. But still I am doing it. What will be earning after tax? 60,000. I know that depreciation is non-tax, non-cash. Also, we know we are considering depreciation just to get tax benefit on depreciation. Remember chapter of cost of capital. If you want to find out the tax benefit on any expenditure, we did example of newspaper, we did example of petrol. If you want to find out the tax benefit on depreciation, it will be nothing but depreciation multiplied by tax rate. Sir, we were not doing this depreciation into 1 minus t. No. You multiply 1 minus t if you want to find out after tax benefit cost. If you want to find out your real cost, then you do 1 minus t. If you want to find out just the tax benefit, you do depreciation multiplied by tax rate. So what is the tax benefit on depreciation in our case? What is depreciation? 40,000. What is tax rate? 40%, which will be equal to 16,000 rupees. So because of depreciation, try to understand, I am elaborating it. Because of depreciation, which is our expenditure, there will be tax benefit, which will be cash benefit of 16,000 rupees. So I have not deducted depreciation over here. Agreed. But I can directly add tax benefit of depreciation, which is 16,000. So what will be my cash flows? 76,000. And believe me, answer by this method and answer by this method are always same. They are not a different method. Try to understand. What is correct tax? 24,000. What tax we have taken over here? 40,000. So we have not considered that tax benefit of 16,000, which we are considering it over here. The 16,000 we are considering it over here. And so answer is going to remain same. So what I have done practically, instead of doing this, EBDIT, depreciation is yet to be deducted. This will be EBIT minus interest. This will be EBT minus taxes. This will be profits or EAT plus depreciation. I will be getting answer of cash flows. What you can do instead of this? Instead of this, you can do EBDIT. You know depreciation is not a cash item, so don't deduct it. Directly deduct interest. Whatever is the answer, deduct the taxes, which will be incorrect taxes. Why it is incorrect? Because tax benefit on depreciation is not considered. You will be getting earning after tax. Now what you need to do? You cannot add back depreciation. Why you cannot add back depreciation? Because you have not deducted depreciation anywhere. Here you are adding back because you have deducted it. Here you will have to add what? Nothing but tax benefit on depreciation. Once you add this tax benefit of depreciation, you will be getting answer of cash flow, This both answer are exactly same. They are not different. They are exactly same. This is just another mathematical way of finding out cash flows. What we are summarizing, how to find out cash flows. How we do it? Sales minus variable cost minus fixed cost excluding depreciation minus depreciation minus interest I get EBT minus taxes I get EAT plus depreciation I will be getting answer of cash profit. And why I want answer of cash profit is very simple, because in NPV everywhere it is not profit is a vague term. Gross profit, net profit, contribution profit. Cash is always a fixed word. What is cash, right? So present value of cash inflow minus present value of cash. So in finance, cash is important, and this is how we find out cash flow in a particular situation. We have gone through first method of capital expenditure decision, which is nothing but NPV, present value of cash inflow minus present value of cash outflow. Try to understand. A project is going to work for 10 years. I'm taking an oral example. Just try to concentrate. A project is going to work for or run for 10 years. After which full company will be sold and everything will be closed. So the cash flows which are generated are for 10 years. Say my sales in year 1 in units were 5,000 units. And sales for all 10 years is 5,000 units. So for all 10 years, the sales is going to remain 5,000 units. Selling price per unit is rupees 10 for first 5 years. And then it is rupees 12 for another 5 years. So I will be getting total sales, which should be very easy for you. Total sales is nothing but selling price per unit multiplied by units sold. So I will be getting answer of total sales. My variable cost is 40% of sales. It is 40% of sales. So sales multiplied by 40%, I'll be directly getting answer of variable cost. Fixed cost is 5,000 rupees per month. For all 10 years, the fixed cost is 5,000 rupees. There are no other fixed cost. No fixed cost which are there as far as other fixed costs are concerned. I'll find out depreciation, but what are my profits for first 5 years? Profits are 25,000, and for next 5 years profit are 31,000. I hope all of you understand how I'll be getting profit. It is the sales minus variable cost minus fixed cost. I will be getting answer of profits. A depreciation I need to find out. How to find out depreciation? Try to understand. The machinery will be costing me machinery will cost me 2 lakh rupees. Machinery will be costing me 2 lakh rupees. Depreciation rate is 10% WDV. I have made a chart in Excel, so I directly get answer of depreciation, but I expect that all of you know how to find out depreciation as per WDV. So in first year, it will be 2 lakh multiplied by 10%, which will be 20,000. In second year, what will be WDV of at the end of first year is 1,80,000 multiplied by 10% is 18,000. Third year 16,200, fourth year 14,580, fifth year 13,122, sixth, seventh, eighth, ninth, and 10th. This is important. What is a WDV? At the end of 10th year is 69,735.69. This is nothing but WDV at the end of the year. But what are my depreciations for 10 years? Those are depreciation for 10 years and it will automatically come over here as this is Excel sheet, right? Understand, in examination, you will have to require this to solve without an Excel sheet. So your speed on calculator should be immense. Your writing speed should be immense to solve this type of question. And you should be doing it without doing any mistake. I am having Excel sheet, so there are no scope of mistake. So from sales, I have deducted variable cost, I have deducted fixed cost, I have deducted depreciation. I got answers of profits. I have got answers of profit in first, second, third, fourth, all 10 years. The tax rate for this company is 40%. It is 0.40. So tax, how the tax will be calculated? Profit multiplied by 40% will be nothing but tax. So 2,000, 2,800, 3,520 is taxation for all 10 years. Earning after tax. How I have found out earning after tax is nothing but profit minus tax is nothing but earning after tax. Is it earnings or is it cash flow? Those are earnings. They are not cash flows, right? How to convert earnings into cash flow? Very simple. It is earning after tax plus depreciation. So this 3,000 plus 20,000 will be 23,000. And I can do it for all the columns. So cash flow for all the years is nothing but this. These are 10 years of cash flow. Still, you might be thinking, sir, we need to do it in book with calculator. It is a lengthy process. I'm not saying it is a difficult process. It is a lengthy process. The discount rate for this type of this company, say XYZ Limited, discount rate is 12%. So discount rate, we have taken 12%. And then still understand, if you want to solve this question in your book, this all are cash flows. You will have to find out the present value of cash inflow at the rate of 12%. Many a times a student asks me, sir, you are solving it in Excel. We need to solve it in the book. How we should do it? As per my opinion, if these are cash flows, open your calculator, find out the factor or 1 rupee factor for this present value. What will be 1 rupee factor for first year? What is your discount rate? 12%. So 1 divided by 1.12, that is nothing but 0.89. Write it down over here. 0.89. What will be second factor? 1 divided by 1.12. You have already pressed is equal to. Press one more time is equal to. Write down this factor over here. Write down this factor in third column. Third row. 4th, 5th, 6th, 7th, 8th, 9th, 10th. Take it up till 2 decimal or take it maximum up till 3 decimal. Write down in your answer an assumption that factors are taken at 2 decimal. You might get difference of 100 or 200 rupees, but that is absolutely all right. Calculative marks are not cut in your examination. Logical marks are cut for your answer in CA examination. You can write down the factor, make one more column and ultimately you will be getting present value of cash inflow. As I am having an Excel sheet, I am directly getting present value of cash inflow as 1,24,398. So what I have done is very simple. Sales minus variable cost minus fixed cost minus depreciation, I have got profits. I reduce the taxes, I got EAT, and I got answer of cash flows. Try to understand one or two more things. We are having cash flow for 10 years. But we will also have to find out what is a cash outflow today. So what is a cash outflow today? Our machinery is costing 2 lakh rupees. So 2 lakh rupees is cash outflow today. If you want to do this project, you will have to purchase this machinery, and your cash outflow at the end of 0 year, not at the end of first year, will be 2 lakh rupees. So I am going to this, that is a cash outflow, present value of cash outflow. Try to understand one or two more things. Number one, at the end of period, that is 10 years in our case, this machinery will be sold in scrap. This machinery will be sold in scrap. When you sell your machinery, there is a cash inflow. Sir, it might be sold at loss. Loss or profit? I am talking about cash flows. Even if this machinery is sold, there will be positive cash inflow. There will not be cash outflow. Even if it is sold at loss, there will be positive cash inflow if the machinery is sold. And this will be at the end of 20 years. And suppose this machinery is sold at 1 lakh rupees. This machinery at the end of 10 years in scrap is sold at 1 lakh rupees. Then this 1 lakh rupees should be added to cash flow of 10th year. Sir, you will say it is not a profit. Agreed. I am right now not finding out profit. I am finding out cash flows. See this answer. These are not answers of profit. They are profit of cash flow. So in 10th year, in this, I need to add 1 lakh rupees more. I will add it in 10th year in this chart also in a different manner. But first you need to understand the scrap value, selling price of machinery at the end of period. Right? Point number 2, try to concentrate. This machinery was sold at the end of 10th year. I am assuming there is only one machinery in this particular project. So there is no concept of that block of asset which you have learned in your taxation. There was a single machinery only. What was, this is point number 1. I am going to point number 2. What was the WDV of this machine at the end of, this is not 20th year, 10 years. WDV of machine at the end of 10th year. Now, if you are doing this answer question in the book, believe me, it will take a lot of time to find out, but I am having that ready answer. What is WDV of machinery at the end of 10th year is 69,736 rupees, 69,736. This is the WDV of machinery at the end of 10th year. In my books, the machinery is valued at 69,736. But I have sold at 1 lakh rupees. A machinery which is of 69,000 rupees is sold at 1 lakh. There will be gain or there will be loss? There will be gain. Of how much rupees? 1 lakh minus 69,736, which is 30,264. Sir, then this gain is a cash flow at the end of 10th year. 30,264. No. We have already calculated this 1 lakh rupees. We have taken this 1 lakh rupees at the end of 10th year. Now you cannot say the gain is more cash flow. 1 lakh rupees we have already considered as cash flow. And this gain of 30,264 is already included in this 1 lakh. Sir, then why we found out this gain? Try to understand. If you are earning profits, there is government who is standing there to take taxes from you. If there is a gain, you will have to pay tax. If there is a gain, you will have to pay tax, and so your cost will increase. How much tax is to be paid? Multiplied by, I am assuming that the capital gain tax and normal taxes are same. So tax is 40% multiplied by 40%. This is payment of tax. It will be at the end of 10th year. How much tax will be paid? 30,264 multiplied by 40%. Which is 12,106 rupees. What is this? Tax on sale of machinery at the end of the period. What is to be done? If there is a gain, you will have to pay tax. Sir, if there was loss, then multiplied by 40%. Whatever is your answer is the tax benefit at the end of 10th year. So positive cash flow, this will be negative cash flow, this will be positive cash flow. Please understand, we are talking about tax. So gain will increase our cash outflow and loss will decrease our cash outflow. So we are knowing this. And we should consider this. So 2 points. Number 1, selling of machinery at the end of the period, there will be cash inflow at the end of the period. When we sell the machinery, there might be either profit, which will result into cash outflow. There might be loss, which will result into cash inflow, that is tax benefit on loss. And in our case, this tax should be cash inflow at the end of 10th year. All right. Third and last. Working capital. Try to understand. I normally explain working capital by example of a bookstore. See, I have purchased the office, which is a bookstore. I have installed AC, I have installed furniture, everything is done. After this bookstall is ready, can I directly open a shutter and start this bookstall? No. What I'll require books, I'll require pen, I'll require stationery, everything I need to pile up the stock. And to pile up that stock, I will require rupees 1 lakh to purchase books, stationery, stapler, pens, all the raw materials which I'm going to sell in my bookstall. I need, and how much money I want? 1 lakh. See, when you are purchasing your office, it is not a working capital requirement. When you are purchasing furniture, it is not working capital requirement. But when you are purchasing your raw material or finished goods or WIP, it is your working capital requirement. Right? And what to do about this working capital requirement? Try to understand first answer. It will be cash outflow at the end of 0 year, that is today. All of you agree? Before starting book stall, I will have to pay this 1 lakh rupees to someone. So working capital will be cash outflow at the end of 0 year. And when I will be getting back this 1 lakh rupees, can anyone tell me when I will be getting back this 1 lakh rupees? In year 1, year 2, year 3, any student can give me answer. When I sell these goods, what is your answer? I am saying when I will be getting back this 1 lakh rupees. The answer is, say, first year. No. See, when you will be selling all this 1 lakh rupees, your book stall will become empty, which is not viable. You will again have to pile up the stock. So once these are sold, again you will have to bring books, stationery, staplers and everything. Again when they are sold, again you will have to bring it. So you will never get this back. When you will be getting this back, rupees 1 lakh is at the end of 10th year. Working capital, see, if you understand logically, it is somewhat difficult. Otherwise, it is very simple. It is cash outflow today. It is cash inflow at the end of period. That is in our case at the end of 10th year. Working capital is cash outflow. At the end of 0 year, it is cash inflow. At the end of 10th year, same amount. Selling of machinery, if there is a profit, there is cash outflow. If there is a loss, tax will be inflow. And when you sell your machinery at the end of the period, this always will be cash inflow. So let us, I'm taking this as a different figure in this particular, I can take 1 lakh rupees. It does not matter if our business is very small, but I can take 1 lakh rupees. So I am incorporating all these 3 figures in my statement. At the end of 0 year, please understand, there is a cash outflow of 2 lakh rupees. Plus, there will be more cash outflow of working capital, which will be totally coming to 3 lakhs rupees. What is this? Present value, because it is value as on today, of cash outflow. So a present value of cash outflow as on today is 3 lakhs rupees. How? 2 lakh rupees you will purchase machinery, 1 lakh rupees you will invest in working capital. Your total cash outflow will be 3 lakhs rupees. So total cash outflow, let me write it down in my minus present value of cash outflow is nothing but 3 lakhs rupees. All right. What is cash outflow for my machine at the end of 10th year? Sorry, this is also to be added, right? So at the end of the period, what is my cash at the end of the period? Let me see what is my cash at the end of the period. It is 21,700. So this is at the end of 10th year, my cash inflow is 21,700. All of you agree? What will happen in 10th year? I will be selling my machinery. I will be selling my machinery. There will be cash inflow of 1 lakh. I will have to pay the tax on capital gain because I have sold the machine. I have earned a profit, and on profit I'll have to pay tax. So I am paying tax. If I'm paying tax, it should be minus. Minus. How much tax I am paying, I've already found out. It is 12,106 rupees. And I will also get my working capital back, which is 1 lakh rupees. So these two are different things. This is because I am selling my machinery. This is because I will be getting all my working capital back. Now the project is closed. I need not reinvest that working capital. I will be getting this working capital back. What to do with working capital? Cash outflow at the end of 0 year, and it is a cash inflow at the end of 10th year. So I will add this 1 lakh rupees, which is working capital or recovered. What will be my cash inflow at the end of 10th year? 21,700 plus 1 lakh minus 12,106 plus 1 lakh rupees is 2,09,594. This is the cash inflow at the end of the period. 2,09,594. How? Our operating cash flow is 21,700. I am selling my machinery at 1 lakh rupees. Because I am selling my machinery, I need to pay tax of 12,106. And working capital, I will be getting back because I need not reinvest it now. And so this total will be 2,09,594. 2,09,594. 2 lakh 2,09,594. Will be cash flow at the end of 10th year. I have considered all the things, all 10 years. Cash outflow at the end of 10th year is 3 lakh rupees. Let me see what is my NPV. It is positive or it is negative. It is negative 1,15,105. Any NPV which is negative, what I do is I reject my proposal. So if this is machinery, I will not purchase the machinery. What is the reason? I am not earning 12% rate of return. If someone asks you the reason, it is always I am not getting my required rate of return. This is how we solve the questions of NPV of capital budgeting, by finding out cash flow and then finding out present value of cash inflow minus present value of cash outflow, and I will be getting the answer. Try to understand, I am just representing it in a very small manner. Suppose there is a project which is running only for 3 years, right? So for all 3 years, there will be operating profits. Operating profits. Let me write down even after tax. There will be operating profit after tax. At the end of the period, I will be having cash inflow. Why I am adding it? Understand. If it is inflow and again inflow, I need to add it. So I am doing plus scrap value of machinery. What will again happen in last year? Plus minus. Now this answer can be plus, this answer can be minus. Minus if we are paying tax and plus if we are getting tax benefit. What will be plus minus? Tax on capital gain. Because you are selling your machinery, there will be capital gain tax applicable. Once the capital gain tax is applicable, either you might be getting tax benefit or you might be paying the tax. And third will again always be plus. What is it? Is nothing but working capital recovered. This is nothing but cash flow at the end of the year. And this is exhaustive situation. It will not be having any other point. At the end of 0 year, this is today. Now this all are cash inflows, these are cash outflow. Right. Let me write down this are cash inflows. In inflow, we plus inflow, we reduce outflow. In outflow, we plus outflow, reduce inflow. This is very simple mathematics. What will be cash outflow? First of all, cost of project plus working capital required. See, even if this both sign are plus, that does not mean here it is cash outflow and here it is cash inflow. So cost of project plus working capital requirement will be nothing but cash outflow. So outflow will be negative. I will be getting cash outflow by this red color figure. First year, second year operating cash flow only. No other cash flows are there. Third year operating cash flow plus scrap value of machinery plus minus tax on capital gain plus working capital requirement. And this is exhaustive way of finding out cash flow of any capital budgeting project. There will not be any other cash flows except this. So if you consider this 1, 2 and this 3 points, the the NPV questions become somewhat easy. We have done this one oral question of NPV. So what we have completed? Net present value. How to find out net present value? Very simple. It is present value of cash inflow minus present value of cash outflow. How to find out the present value of cash inflow? Say year 1, 2, 3. If there are only 3 years, how to find out present value of cash inflow? First, you need to find out operating cash flows. How to find out operating cash flows? It is sales minus variable cost minus fixed cost except depreciation minus depreciation. You will be getting EBDIT minus depreciation. You get EBIT minus interest minus tax. You will be getting earning after taxes. You add back depreciation, you get operating cash flows. In second year also operating cash flows, and if the project is for 3 years, then in last year operating cash flows plus what are other additional cash flows is sales value of asset. What are other cash flows? Plus minus tax on capital gain. If there is a loss, there will be tax benefit. If there is a income, there will be tax loss. Plus working capital recovered. I will be getting cash flows. I will have to take a discount rate, find out present value. I will be getting present value of cash inflow. How to find out cash outflow at the end of 0 year? First, cost of asset. Another, there will be cash outflow of working capital invested. It will normally be present value itself. So this is present value of cash outflow. I will get answer of NPV. It may be either positive. If NPV is positive, we will accept the project. If NPV is negative, we will reject the project. If NPV is equal to 0, we are indifferent. Again, if NPV is positive, the project is earning more than required rate of return. NPV negative, project is earning less than required rate of return. If NPV is equal to 0, project is exactly earning required rate of return. And we summarized first method, that is net present value. We can easily take capital expenditure decisions. Let us go to method number 2, which is exactly same as NPV, but right now let us go to second one, which is PI, which is profitability index. What does this method says? Find out PI by present value of cash inflow divided by present value of cash outflow. You will be getting answer of PI. See the decision making criteria. If PI is greater than 1, you should accept the project. Believe me, in this case, your NPV will be positive because numerator will be higher than denominator. So your NPV will be positive. If PI is less than 1, you should reject the project. And believe me, your NPV will be negative 100%. And if PI is equal to 1, this is where we can start our understanding. If present value of cash inflow is 100 crore and present value of cash outflow is 100 crore, PI will be is equal to 1. 100 crore divided by 100 crore is 1. You are indifferent. And if present value of cash inflow is 100 crore and present value of cash outflow is 100 crore, your NPV will be equal to 0. Sir, it is just mathematics. I agree. In NPV, it is present value of cash inflow minus present value of cash outflow. So when both are same, we get 0 answer. Here it is division. So when both are same, we get answer of 1. Sir, then why it is a separate method? That we are going to learn when we solve the concept of capital rationing. We will be doing concept of capital rationing. At that time, I tell you that NPV is important, but PI is important when you do capital rationing. Otherwise, conceptually, still the answer remains the same. Let me go to our question. What was present value of cash inflow? 1,53,612 divided by what is present value of cash outflow? Is 3 lakhs rupees. So if I want to find out PI, can I find out PI? Yes. It is 1,53,612 divided by 3 lakhs rupees. 0.512. What is PI? 0.51. Will you accept the project, reject the project, reject the project? In this case also we were rejecting the project because NPV is negative. So decision making is going to remain same as far as PI is concerned and NPV is concerned. See the PI decision. If it is less than 1, in this case it is less than 1, You should reject the project and NPV will be 100% negative. Second method, profitability index, brother of NPV or same as NPV. There is no difference between NPV and PI. PI will be used in a specific situation, which is capital rationing. Method number 3. And one of the most important method, which is IR, internal rate of return. Believe me, if this question is asked in examination, this is a lengthy question always. IRR can be found by trial and error. IRR can always be found by trial and error. What is IRR? Try to understand. There is a company X Limited whose required rate of return or discount rate is 12%. Is how much? 12%. They are planning to purchase a machinery. And following are the cash flows. See the cash flows. They will be generating this much amount of sales, 1,000 units every year. At a selling price of 20 per unit every year. Fixed cost is 1,000 rupees. All the rupees say are in crores. Variable cost is 40% of sales. There are no other fixed cost. Depreciation is 2,000 rupees every month. So it is not from that chart. It is directly 2,000 rupees every month. Profits are 9,000. Taxes are at the rate of 40%. So earning after tax are 5,400 and cash flow. How to find out cash flow? Earning after tax plus depreciation of 2,000 will be cash flows. And this remains the same every year. Everything remains the same every year. There is no change in your cash flow. At the end of the period, the machinery value is 0 and the cash flow for 5 years we have already got it. These are cash flow for 5 years. What is the required rate of return for this company? 12%. What is the present value of cash inflow? 26,675. Now you all are very comfortable with this Excel sheet. You need to calculate it. For you it will be lengthy task, but for me it is very easy task because all the calculations are done online. Present value of cash inflow is 26,000 and machinery is costing 20,000. What is NPV? NPV at 12% rate of return, which is required rate of return. NPV at 12% rate of return, which is my required rate of return, is 6,675 rupees. NPV is positive or negative? Positive. Should you accept the project or not? Yes. Because NPV is positive. How much rate of return this machinery is earning? Can anyone tell me? It will be earning more than 12% or it is earning less than 12%. And how you came to know? How you came to know that it is more than 12%?
NPV is positive.
NPV is positive, so the project is earning more than 12%, which is your required rate of return. Agreed. But if someone asks you this, I don't want this answer more than 12%. I want how much is the exact rate of return this machinery is earning. I am still giving the answer more than 12%, but that person does not require more than less than figure. He is saying, tell me the number, 17%, 15%, 20%, 25%. How much percentage this machinery is earning? How much percentage this project is earning? Believe me, that person is asking us this question. In short, he is asking us, what is internal rate of return? What is the rate of return at which NPV is 0? If NPV comes 0, that means the project is earning that discount rate of return. Ultimately, we are giving him answer that project is earning more than 12%. He wants exact answer how much percentage project is earning. And here comes the concept of IRR. IRR is nothing but rate of return. It is not required rate of return. Huh? It is rate of return at which NPV is 0. Because we know whenever NPV is 0, the project is earning discount rate. Sir, but NPV over here is a plus 6675. Agreed. But I can find out the rate. What was the discount rate over here? 12%. I can find out the rate at which NPV is 0. Sir, is there any formula? There is no formula. There is just a trial and error. Try to understand what I am doing. I know the project is earning more than 12%. So I start with this. Suppose project is earning 14%. If rate of return is 14%, what will be my NPV? See, for you, you are having this 5 years cash flow. You will have to find out present value on your own. Minus 20,000. You will be getting NPV and you need to give me answer of NPV. What will be NPV? 6675. Sorry, at 12% it is 6675. Positive. At 14%, you will have to find out. It will be a lengthy process for you. Probably it might take 2-3 minutes. For me, it is easy because I can just convert here 14% and I will be automatically getting NPV, which is 5405. Because the cash flows are equal, I am getting answer in the checks, but that is because cash flows are equal. You can easily do it with GT and so you are getting the answer. I know I need to reach. What is your target? You want NPV 0. So let me try out some other figures. At 18% rate of return, what will be my NPV at 18% rate of return? Is 3141. See, are you getting it? As I am increasing my percentage, NPV is decreasing. This concept I'll be using ahead. As I increase my percentage, My NPV is decreasing. Let me try at 25%. So for you, you will have to calculate every time. For me, it is very easy. At 25%, NPV is minus 99. Let me find at 24% even. What will be answer at 24%? It is 316. Rupees 316. All right. Now try to understand. I am having one positive NPV and one very near negative NPV. Here it is positive 316. Here it is negative 99. See, if rate of return is 24% and the NPV is positive, what does it mean? Project is earning more than 24%. If NPV is negative at 25%, what does it mean? NPV is, ROR is less than, IRR is less than 25%. The project is earning less than 25%. Please understand, I have got the range. What I have got? I have got the range. That is, this project is earning between 24 and 25%. See what answer I am giving to this person. First I was telling him it is greater than 12%. Now I am giving him range. It is between 24% and 25%. So it is between 24 and 25. Still this person is adamant. What he is saying, I want exact rate of return this project is earning. I want exact rate of return this project is earning. So I will have to do interpolation. Try to concentrate. What is NPV at 24%? 316. What is NPV at 25%? Minus 99. What is the required NPV? Please understand, everything can be used when there are two rates. In one rate NPV is positive, in one rate NPV is negative. Then only interpolation can be used. For interpolation is an approximation method by which you can find out approximate answer at which NPV will be 0. What is my required NPV? 0. So I want NPV 0. I am taking this logic from previous page. As I increase the percentage, my NPV decreases. All right. Let me compare this to how much percentage it has decreased. 25% minus 24%. That is equal to 1%. The percentage, the discount rate, the rate has decreased by 1%. How much NPV is decreased? Someone in hurry will do this. Please understand. 316 minus 99. It is 217, which is not a correct answer. I want to find out the difference. Try to understand mathematics. It is 316 minus 99. So it is a 316 plus 99, which is 316 plus 99 is 415. 217 is not a correct answer. 415 is a correct answer. What is 415%? Decrease in NPV. I am taking again a new page. If there is an increase in percentage of 1%, there is a decrease in NPV of rupees 415. This is what I have concluded from here, right? See, those who don't understand this mathematics, this is this. 2 and minus 1. The difference is not 1, difference is 3. This is 0, 1, 2, minus 1. See the difference, 1, 2 and 3. How to do it? 2 minus 1. So the difference is 3. If I increase my percentage by 1%, my NPV is decreasing by 415 rupees. Starting from this 24% as base. Starting 24% as base, how much percentage I should increase so that the NPV decreases by only 316 rupees? Why I want to decrease NPV by 316 rupees? What is NPV at 24%? 316. If it still decreases by 316, my answer will be 0, which is nothing but my required NPV. So if I want to decrease only 316 rupees NPV, because I want NPV 0, how much rate I should increase after 24%? After 24%, if I increase 1%, my NPV is decreasing by 415 rupees. I want to decrease NPV only by 316 rupees because I want NPV 0. Then how much percentage I should increase? The answer will come in points. It is 316 multiplied by 1 divided by 415. It's 316 divided by 415 multiplied by 1, which is 0.76. So what is first 0.76? Try to understand. The answer is 0.76. After 24%, if I increase by my rate by more 0.76%, after 24%, if I increase my rate by more 0.76%, then after 24%, my NPV will decrease by 316 rupees. At 24%, what was NPV? 316 rupees. Now it will reduce more by 316. So NPV will become 0. And so at 24.76%, NPV will be 0. Now that person was asking us question, how much exact rate of return this machinery is earning? We can easily give him answer. 24.76%. This project is earning. Now we are giving him, still this is approximate. I am giving him the answer. This project is earning more than 12%. He is not ready to accept this type of answer. I give the answer, it is between 24 and 25%. He is still not satisfied. Now I am giving him answer that this project is earning 24.6% per annum, and now he is satisfied. What is 24.76% is IRR? Now you can understand this. The rate of return at which NPV is 0. So the project will be earning this rate of return, and so only the name. Internal rate of return is nothing but 24.76%. Let me verify whether my answer is correct or not. If I write down this as 24.76%, see my NPV. It is coming -1, but ultimately it is very near to 0. So my approximation method is correct. Alright, it is 24.76. It is the rate at which NPV will be 0. Try to understand some of the misconceptions running around NPV, IRR. What is NPV of this project? Help me out. Khushali, Shabina, Simran, anyone can help me out. What is NPV of this project? There are 5 NPVs written on the screen. No one? NPV of this project is 0. No. What is the required rate of return of company? Let me also write down this answer. What is required rate of return of company? It is 24.76%. No. What is actual rate of return project is earning? This is 12%. The answer is no. Let me write down correct answer. What is actual rate of return project is earning? 24.76%. What is the required rate of return of the company? 12%. What is the net present value of this project? Net present value of this project is always at required rate of return, that is 12%. NPV of this project is still plus 6675, which is at 12%. So it is a plus rupees 667. And the third answer is nothing but IRR. Never say this project is earning 0 rupees. Huh? This project at 24.76% will be earning 0 rupees, will be having NPV of 0 rupees. Your NPV is still plus 6675, so you should accept the project. Required rate of your company will not become 24.76. It will still remain 12%. And actual rate of return this machinery, this project is earning is 24.76%. This is very important to understand. If someone asks you what is NPV of this project, the answer is still 6675. If someone asks you this question, how much exact rate of return this project is earning, is 24.76, which is nothing but internal rate of return. Right? Now, sir, every time we will do this? The answer is no. Try to concentrate. I am rewriting it once again. 24% to 25%. What is my NPV at 24%? I am just rewriting it and I'll create a formula. It is 316. This is minus 90. First of all, to use any interpolation technique, first you should be having range. What does it mean? This answer should be positive, this answer should be negative. Yes, you could have found out 23% and 25%. I don't mind, right? Then, what is the formula? First 24%. Let us take this as base. So IRR is equal to base rate plus, because we are doing approximation between 24 and 25%, plus 316. What is 316? Positive NPV. From where positive NPV? Out of this two, which is positive NPV 316. So positive NPV divided by, what is the 415? 415 is neither positive NPV nor negative NPV. It is difference in NPV multiplied by 1. What is 1? Difference in the rate. And this is how we can use this formula if there are only two rates. In one NPV is positive, in another NPV is negative. We can use this formula to directly find out IRR. Let me once again do this in calculator. 24% plus, what is positive NPV? 316. What is difference in NPV? 316 plus 99. This we have done. 415 multiplied by, what is difference in rate? 1. This is 316 divided by 415 multiplied by 1 remains as it is plus 24 is 24.76. The rate at which NPV will be 0, this is nothing but my IRR. Now onwards, instead of every time doing logically, once I get a positive NPV rate, once I get a negative NPV rate, means once I get a range, I will be using this formula and finding out the answer. Once again, I am summarizing the formula. It is base rate plus positive NPV upon difference in NPV multiplied by difference in rate. Directly interpolation will be used. I have told you n numbers of times before. I am not against mugging up the formula. I am against not knowing anything and mugging up the formula. You should understand that this is nothing but approximate between 24 and 25%. We are trying to make an average by a method which is known as interpolation method. This is IRR. What is the meaning of IRR? IRR is the rate at which NPV is 0. This is third method for taking capital budgeting decision. Now you will tell me, sir, if IRR is 30%, first of all, this is not my discount rate. This is the rate which is actually earned by project. Agreed? You will say, sir, how we will take the decision? Then you can also make a decision making criteria. Understand? If IRR is greater than your required rate of return, you should accept. If actual rate of return is less than your required rate of return, you should reject. And if IRR is equal to your required rate of return, you are. See, no one only finds out IRR. All the capital budgeting decisions are taken by NPV. But IRR is one additional information which is better for the company. Why I tell you? just because you will actually know how much exact percentage the project is earning. This is concept of IRR, internal rate of return. Understand your examination problem. Let me just take another question and do IRR. Say my cash flow for the purpose of one of the project of 5 years is 5,000, 6,000, 7,000, 8,000 and 9,000. These are my cash flows. Cash inflow for the period of 5 years. So this all is practically not there. I am directly giving you cash flows. My required rate of return for the company, 1, 2, 3, 4, 5. Cash flows are 5,000, 6,000, 7,000, 8,000 and 9,000. Required rate of return of company is 8%. What is ROR of company? 8%. So discount rate is 8% for the company. What is the present value of cash inflow? It is 27,336. This is nothing but present value of cash inflow. What is present value of cash outflow? What is the cost of the project is 25,000. What is cost of project is 25,000. So present value of cash outflow is 25,000. What is NPV at 8%? And this is my actual NPV. If someone asks you question of NPV, NPV is always discounted at company's required rate of return. So what is NPV at 8%? I will be directly having it. See, now you are sitting in the examination, you will have to calculate it. You will have to find out present value for all the figures and you will have to find out NPV. People ask me, sir, how we should find out the present value? This is a very simple thing. Write down over here 1 divided by 1.08. Whatever is the answer, write down over here in 3 decimal. Is equal to, write down a factor over here. Is equal to, write down factor over here, write down factor over here, write down factor over here. Find out present value. You will be getting present value of cash inflow as 27,336. What is present value of cash outflow? 25,000. What is NPV? 2,336. Positive, negative, positive. Project is earning more than 8%? Yes. I want to find out IRR, actual rate of return company is earning. Let me find out at 10%. What will be NPV at 10%? Why I am finding out? This is just a trial and error. Huh? If this figure is not negative, it is not important for us. I am finding out NPV if discount rate is 10%. So here I am keeping at 10% and let me see what will be my NPV. NPV is 816 rupees. Positive 816. So now this figure for finding out IRR is useless for us. Project is earning more than 10%. So it is earning more than 8% that we are knowing. It is earning more than 10%. Now that also we are knowing. Let me find out answer at 15%. This is also trial and error. I want one answer which is negative so that I can get a range. At 15%, what will be my NPV is minus 2464. Minus 2464. So this project IRR is earning less than 15%. Have I got the range? Yes. See, 10%, 15%, NPV is 816, NPV is minus 2464. That means IRR is between 10 and 15%. Have I got two rates? Yes. One is positive, another negative? Yes. I can take 10% as base. Use IRR formula directly to do that interpolation. See, if this both are positive, you cannot use this formula. This can be used only if both are negative. And you should now logically also understand that this rate will be very near to 10% and not near to 15%. It is very far from 15%, but it is very near to 10%. Let us use the formula base rate plus positive NPV upon difference in NPV multiplied by difference in rate. What is base rate taken by us? 10 plus what is positive NPV? 816. What is difference in NPV? 2464 plus 816 and not minus 816. 3280. Difference in rate is 5% or 5. I am removing percentage from everywhere. So what will be my answer? 816 divided by 3280 multiplied by 5 plus 10. 11.24 percentage will be my IRR. Quickly, one of the students give me the answer. What is a required rate of return of this company? What is required rate of return of this company? It is 8% and not 11.24%. 11.24, this project is actually earning. Company still requires 8% rate of return. Will this project be accepted? Yes. Two reasons. NPV is positive. This is our NPV. NPV is positive. Number two, your project is earning more than your required rate of return. This is nothing but concept of IRR. What you need to do in examination? First find out NPV. Then do 2 or 3 rates as a trial and error. Get 2 rates where one is positive, another is negative, so that you get a range. Use the formula, directly find out IRR. I am also verifying whether my answer is correct or not. At 11.24, at 11.24, what should be the NPV is very near to 0. What is it? Minus 63. Is it very near to 0? The answer is no. But still understand, this technique is approximation technique. Interpolation is approximation technique. Sir, in previous question we were getting difference of 1. In this question we are getting difference of 63 rupees. Why? Can anyone suggest me why? Why we are getting a big difference even if it is an approximation method?
There is more difference in rate.
Exactly. This we have taken 10%, 15%. In previous question, we have taken 24% and 25%. Let me try out with, in this case, 12% also. So at 10%, 816, at 12%, as I am having computer, I can easily do it. At 12%, my NPV is minus 579. Minus 579. Interpolation, IRR, base rate plus positive NPV divided by difference in NPV multiplied by difference in rate. What is base rate? 10 plus positive NPV 816. Difference in NPV is 816 plus 579 1395 multiplied by 2. 816 divided by 1359 multiplied by 2 plus 10. It is the 11.20 percentage. What this was coming? 11.24. Now what is coming? 11.20, because we have changed the difference of this rate. Where what even if you find out 11.50%, your difference will be still rate. But please understand, you can follow your answer by this. It is approximate. Let me find out what is the difference at 11.20%. If my rate is if my rate is 11.2, see, it is still coming minus 35, right? But the difference has decreased. Now it is very near to 0. First it was minus 67. Now it is minus 35. So this is approximation method. You don't need to do this in examination. But understand, this is how we find out internal rate of return if only calculator is available. See what we were doing? We were taking our pen and book, finding out this interpolation technique. Still the answer which we are getting is an approximate answer. See why I tell to my students, knowing how to calculate is not important in these days. It is important only for examination. See, I am taking Excel sheet. I have written the same cash flow. In 0 year, I am having a cash outflow of 25,000, 5,000, 6,000, 7,000, 8,000 and 9,000. These are the cash flows which we have written in our sheet. We use the formula, found out the answer, which is still approximate answer. In Excel, you can directly do this. I have found out already, but you can write down is equal to IRR in the bracket. Just select all the values, put enter, you will be getting answer of IRR exactly. What is IRR? 11.14892. Let me verify. 11.14892. See my net present value at this rate. You all are comfortable with this chart. My net present value is coming to 0. If the rate is 11 point, this Excel will round it off, but it will take the actual figures. The actual IRR is 11.1489. 11.1489%. Sir, this is incorrect. No, because this we have found out by approximation technique. Now, a 6, 7, 8 marks question in your examination, Excel can find it out just by one formula. So calculation in practical life will not be important. By this pen, I have learned the calculation when I became teacher. Otherwise, I was knowing only in Excel. So IRR in Excel can be found out in 1 second. In your academic life, it will take more than 15, 20, 25, 30 minutes. Because first you will have to do trial and error of rate of return. Then you will be using that approximation technique of interpolation and you will be getting IRR. Understanding is more important. You need to even pass in examination. So calculation is required, but understanding also should be very much clear. What is IRR? It is the rate at which NPV is 0. It is actual rate of return the project is earning. And here we complete our third method of capital budgeting, which is internal rate of return or IRR. Fourth one, it is payback period. Try to understand. My cash flow in first year is say 10,000. Cash flow in second year is also 10,000. Third year is also 10,000. Fourth year is also 10,000. And fifth year is also 10,000. So my cash flow are in annuity, they are same for all 5 years. My initial investment in this project is rupees 30,000. See the question before learning the concept of payback. In how many years, without considering time value of money, so without discounting the cash flow, my initial investment will be recovered? In first year, how much is recovered? 10,000. In second year, how much is recovered? More 10,000. So what is cumulative cash flow? 20,000. I hope you understand, you are getting this. In first year, we have earned 10,000. Second year, more 10,000. So cumulative cash flow is 20,000. In third year, more 10,000. So totally we have earned 30,000. We have recovered our initial investment of project. So in how many years the initial investment is recovered? 3 years. And this is nothing but payback period. As the name suggests, payback period is number of years in which initial investment is recovered. Number of years in which initial investment is recovered. What are payback period? Payback period are of two types. Understand? Without discounting, so you don't discount your cash flow, is also termed as simple payback period. And with discounting, same thing, number of years in which your initial investment will be recovered as far as your cash flow is concerned. This is known as discounted payback period. What is payback period? Number of years in which your initial investment is recovered. Right? Concentrate. Here I have got answer of 3 years. The cash flow is the same. You can easily find out answer by a formula. People also create a formula in this manner. Initial investment divided by cash flow per annum. Initial investment is 30,000, cash flow per annum is 10,000. So answer is 3 years. You can do it, but this formula can be used only in a single situation. Without discounting, cash flows are equal. Only in that scenario you can use this formula. So I normally do this logically so that I don't need to remember any formula in payback period. Try to concentrate. Formula cannot be used if the cash flows are different. In first year, my cash flow is 1 lakh. In second year, my cash flow is 2 lakhs. In third year, my cash flow is again 1 lakh. And in fourth and fifth year, my cash flow is 10,000 rupees. Now I have kept the formula, so my cumulative cash flow will directly come. My initial investment is 3,50,000 rupees. What is payback period? How much I have recovered up till first year? 1 lakh. How much I have recovered up till second year? 3 lakhs. How much I want to recover? 3,50,000. How much I have recovered in 3 years? 4 lakhs. I don't want to recover 4 lakhs. I want to recover exactly 3,50,000. Try to understand. It is 2 years taken as base. This is 2 years taken as base. How much money you have recovered? 3 lakhs. How much money more you want to recover? 50,000. But you are going to recover 1 lakh rupees in third year. I don't want to recover 1 lakh rupees. I want to recover only 50,000. Yes. Start it. Numerator, more I want to recover. Denominator, total I am recovering in that year. What is the answer? 2.50 years. 2.5 years. I think you get the logic, right? In 2 years, we are recovering 3 lakh rupees. We want to recover more 50,000 rupees, but in third year, we are recovering 1 lakh rupees. So if in third year we are recovering 1 lakh rupees, we want to recover only 50,000 rupees. So we will have to work only for half a year. So the answer will be 2.5 years. Sir, if initial investment was 3,70,000, I am finding out the answer. If the initial investment was 3,70,000, please understand, 2 years plus 70,000. How I have found out 70,000? I have reached up till 3 lakhs. More how much I want to recover? 70,000. Upon what we are going to earn in third year? 1 lakh. Years. It is a 2.70. Sir, if the answer was 56,000, the answer would be 2.56 years, and we can find out the answer. Normal payback, one more time, and then we'll be going ahead. In third year, you are recovering 86,000 rupees. Fourth year, you are recovering 3 lakhs again, and fifth year 10,000. Your initial investment is 4 lakhs. All of you understand it will come between this and this. So what should be taken as base? 3 years, payback period, 3 years, plus how much more you want to recover after 3,86,000? That is only 14,000. How? 4 lakh minus what we have already recovered up till 3 years. 3,86,000. So we want to recover more of 14,000, but in fourth year, 3 years we have already done. In fourth year, how much money is earned? 3 lakhs. Or how much cash flow is earned? 3 lakhs. You will be getting answer. 3 point. This is 14,000 divided by 3 lakhs. It is 0.046. is nothing but payback period. Sir, can't we convert it into months and days? Yes, you can convert it, but it is not required. You are not in finance lecture, then you are in mathematics lecture. This is how we find out payback period method. 3.046 years is nothing but the years in which my initial investment will be recovered. Let me take a simple point. My payback period is 3.5 years. Please don't write this. My payback period is 3 years and 5 months. In decimal, the whole is 1. Out of 1.5 years, that is half a year. And half a year is not 5 months. It is 3 years and 6 months. What is better? Write down this. 3.5 years is correct answer. It does not mean 3 years and 6 months. It means 3 years and it does not mean 3 months, 3 years and 5 months. It means 3 years and 6 months. You should write down in this denomination. Second method, discounted payback. Same thing, same concept, no difference. Understand. Instead of taking simple cash flow, you will have to take discounted cash flow. Suppose my discount rate is 10%. Suppose my discount rate is 10%. And my cash flows are say 1 lakh, 2 lakhs, 86,000, 3 lakhs and 10,000. Try to understand what I have done over here. Instead of taking cash flow, I have taken discounted cash flow. So what I have exactly done? 1 lakh into 1 divided by 1.10 raised to 1. 2 lakh into 1 divided by 1.10 raised to 2. 86,000 divided multiplied by 1 divided by 1.10 raised to 3. So I have taken this factor. How to find out factor? I am having Excel, but how to find out factor in your calculator is very simple. 1 divided by 1.1. Press is equal to write down the factor. Press is equal to write down the factor. Press is equal to write down the factor. Is equal to you will be getting all the factors. You can multiply it with factor. You will be getting discounted cash flows. Instead of finding out payback from cash flows, find out the same payback by discounted cash flows. We are having cumulative discounted cash flows also. If my initial investment is 4 lakh rupees, my discounted payback period will be where 4 lakhs rupees will come in cumulated discounted over here. What I should take as a base? This. It is how many years? 3 years. So 3 plus. How much more I want to recover? 4 lakh minus what I have already recovered, 3,20,811 upon how much will be recovered in 4th year, not 3 lakhs. We need to take discounted cash flow. 2,04,904. And this will be your answer. 4 lakhs minus 3,20,811 divided by 2,04,904 plus 3.386 years approximately. What is the difference? No difference. In one case, we are not discounting the cash flow and finding out simple payback period. In this, we are finding out discounted payback period, which will always be more. If you discount your cash flow will decrease as the time passes and your payback period will increase. So this is discounted payback period and simple payback period. Here the cash flows are discounted, otherwise the answer is same. And let me even convert this into formula. I am not against formula, but I want that first you should logically understand it. If you forget the formula, you should still able to do it in the examination. But let me convert this into formula. What is 3 base year? You need to decide base year from this arrow. Right, in this case 3 years. So I am writing down the formula base year plus what is 4 lakhs? It is nothing but cost or initial investment minus what is 3,20,811 cumulative cash flow up till base year. I am getting numerator divided by what is 2,04,904? It is cash flow of base plus 1 year. It is not cumulative cash flow. Huh? It is cash flow of base plus 1 year. And you can directly find out payback period. Using the formula is not bad, but I still feel if you do it logically in your examination, then also it will be very, very simple. Let me take simple cash flows and do the answer manually. The cash flows for first, second, third and fourth year is 1,80,000, 60,000 and 20,000. Cumulative cash flow, I am finding out simple payback. 1 lakh. 1 lakh plus 80,000 is 1,80,000. 1,80,000 plus 60,000 is 2,40,000. 2,40,000 plus 20,000 is 2,60,000. My initial investment is rupees. First, you need to draw an arrow, select a base year, use the formula base year plus initial investment minus cumulative cash flow of base year upon cash flow of base plus 1 year. Base year 2, initial investment is 2 lakh. Minus 1,80,000 divided by cash flow of base plus 1 year, that is cash flow of third year, which is 60,000. So 20,000 divided by 60,000 plus 2. That is 2.33. In 2.33 years, my initial investment will be recovered. This is payback period. 2 points in payback period. One is without discounting, another is with discounting. Fifth method. Accounting rate of return. Not a very important concept in finance, but sometimes it is also asked in examination, so it is my responsibility to teach you. Accounting rate of return will be everything out of finance. Is equal to average no cash flow, average profits divided by average investment multiplied by 100. That is nothing but what you are earning upon what you have invested multiplied by 100 is nothing but accounting rate of return. Nothing to explain over here. Accounting concepts are used rather than financing concept, And in finance, we find out one answer, which is accounting rate of return. We are going to one more method, which is equalized annual NPV, net present value. Try to concentrate. There is one project, project A. Number of years of this project is 5 years. And the NPV is as follows. Try to understand. I have created this project which is having this much cash flows every year in crores, 7,400, and my discount rate is say 12%. Discount rate is 12%, and my net present value is 1675 crore rupees. The project is good. The project is to be accepted. Please understand, this is 1675 crore rupees. Is my NPV. Or there is another project, project B. The useful life of which is 3 years. And the NPV is as follows. Let me give you the data in my Excel sheet. First, these 2 years are not there. The number of units sold are 1,000, 2,000, and 3,000 units. The selling price per unit is 20. Total sales is 20,000, 40,000, 60,000. Variable cost percentage is 8,000, 40%, that is 8,000, 16,000, 24,000. Fixed cost is so and so. Depreciation is so and so. Profits, taxes, earning after tax, cash flow. And it is the same company, so my required rate of return will be 12%. I am telling you this two projects from the point of view of same company, say XYZ Limited, is planning to take up either project A or project B. And this is for 3 years. My NPV in this case is coming to this. My cash outflow in this case is 33,000. And so my NPV is 763. See my question. Which project should be accepted? Both projects should be accepted because both is having positive NPV. But my question is, which project should be accepted? If either of the project is to be selected. So I want to select project A or I want to select project B. Then which project is to be selected? Say incorrect answer. This project is to be selected because it is having more NPV as compared to this project. But please understand, this NPV is earned by this project in 5 years. This NPV 763 is earned by this project in 3 years. Then if you find out what is per annum NPV, that will be irrelevant. This 763 NPV is earned in 3 years in terms of present value. And this is earned in 5 years in terms of present value. Then you cannot compare a project which is of 5 years against a project which is of 3 years. So this is an incorrect way to calculate. It is a correct way to calculate if this was also 5 years or this was 3 years. But if number of years are not same, this is not a good idea to select one of the project because number of years are different. Then sir, how to select? Please try to understand. I will find out equalized annual NPV under both cases. How to find out equalized annual NPV? NPV divided by number of years, that is 1675 divided by 5. Year 763 divided by 3. Now it seems logical. Why? This is for 5 years, this is for 3 years. If I divide this by 3, this by 5, I will be getting per annum answer. But please understand, in finance, this is also not correct. Because first year will carry higher value of money. Second year will comparatively carry less value of money. Third year will carry less value of money. So first year is different from second year, is different from third year, is different from fourth year, and is different for fifth year as far as finance is concerned. So instead of 5 years, see what I am taking. 1, 2, 3, 4, 5. Instead of this one, what is my required rate of return? 12%. Instead of this value as 1, see what I am taking instead of 1. It is 1 divided by 1.12. It is value of rupee 1 after 1 year. It is 0.8928. So let me not take this as 1. Let me take it 0.8928. The value of second year will still decrease. And how much it will be? 1 divided by 1.12 is equal to. It is 0.7971. So on for all 5 years. And let me find out the total. I can directly do it in calculator. You can do it very easily. 1 divided by 1.12 is equal to 5 times MRC. Recall is your answer. I am not having GT. 1 divided by 1.12 is equal to 5 times, and GT is your answer. I am not having GT, so I need to do with M plus. Is equal to M plus 1, 2, 3, 4, 5. MRC is 3.6047. Instead of taking this as a 5, I am proportionately taking it as a 3.6047 in denominator only. And instead of this 3 years, 1, 2, 3, what is value of first year? 0.8928. What is value of second year? 0.7971. Let me also find out third year and then total out so that you exactly understand it. 1 divided by 1.12 is equal to. That is 0.7117. Instead of 1 of first year, I will be adding 0.8928. Instead of 1 of second year, I will add 0.7971. Instead of 1 of third year, I will add 0.7117. Answer will be 2.4016. And here, instead of 3, this will be divided by 2.4016. What is this answer? NPV? No. What is this answer? NPV? No. Then what is this answer is equalized annual. Equalized annual NPV, which is 1675 divided by 3.6047, 464.67. And this will be 763 divided by 2.4016 is 317.70. Now, can we take the decision by taking these two figures? Yes. Which project should be accepted? This project should be accepted. Sir, this is of 5 years. No, we have done equalized annual. We have converted into annual figure. Here also we have converted into annual figure. Sir, when this method is to be used? When number of years of 2 or more projects are unequal. At that time, you can use the concept of equalized annual NPV. Conceptually, we have completed the chapter of capital budgeting. Now what we'll be doing is we will be solving some of the questions of capital budgeting, which are institute questions which are asked in examination. As far as the classroom is concerned, I need to work less because I am also having a help of Excel. When you are a student, you will have to do n numbers of questions to get correct answers because speed is required, working is required, that concentration is required, and some routine error should not happen. In calculator also you might be making, I make more errors, but you should not be making errors if you want good marks in the question of capital budgeting.